So let's talk about debt first. So as I mentioned, if a utility wants to borrow money to finance infrastructure, it's not going to go to a single bank, and that's because power plants are too expensive and sometimes too risky to be financed by a single institution, a single bank. For example, to fund a power plant with a capital cost or a sticker price of $500 million, a utility might sell 500,000 bonds that each has a principal of $1,000. So if they sold those 500,000 bonds for $1,000 each, that would give them the $500 million that they need to build the power plant. And anyone could buy one of these bonds, even you or me. Investors that buy bonds are called fixed income investors. And fixed income just refers to the fact that there's sort of a predetermined rate of return or profit that you make on that investment. So if you go to Duke Energy's website, there is information for people who want to become fixed income investors in Duke Energy. In other words, to buy bonds that are issued by the utility. And fixed income investing is actually a really important way that Duke Energy can raise money to build lots of different stuff, power plants, transmission infrastructure, etc. So let's actually take a look at what that might look like in a very simplified case from the perspective of an investor, somebody that did buy a bond, $1,000 bond from Duke Energy. And in particular, we're going to look at how that investment of $1,000 would pay interest over time. And let's say the interest that we earn on this particular bond is 4% per year. And that's something that we would know at the time that we buy the bond. So what happens in year zero? We give up our $1,000, we lend it to the utility. And that's the year in which they need our money in order to build the power plant. In year 1, 2, 3, and all the way through year 25, we earn 4% per year on that $1,000. So that's $40 per year. Also in year 25, we get our $1,000 back from the utility. So our original principal is returned to us. So if you add up all our interest that we earned in year 1 through 25 plus our original principal, the total amount of money that we have at the end of year 25 is $2,000. So we made $1,000 on our original investment of $1,000 over the 25-year period. So that's what it looks like from the investor's standpoint in a very simple case. Let's also think about what it looks like from the utility standpoint, and it's a little bit different. From the utility's perspective, things are arranged with a third party, essentially a middleman, a big financial institution like a bank, to look like typical amortization. So what that means is that the utility would pay a regular constant mortgage payment that gradually pays off the loan with interest. So for example, every year the utility might be responsible for making a mortgage payment that consists of two parts, principal and interest. And we can plug this information into an online amortization calculator to get an idea of what this looks like. So the information that's relevant here is the total loan amount. In this case, it's the capital cost of the power plant. That's how much the utility would want to borrow. So $500 million. The interest rate, as we said, is 4%. And the term or the duration of the loan, so how long, over what period of time the loan would be paid back, we're going to assume is the same as the lifetime of the power plant, so 25 years. And so what this figure shows is on the x-axis time, 1 through 25 years, and on the y-axis, annual payments. And so the annual payment on this loan of $500 million is on the order of $32 million. So the utility would pay $32 million every year for 25 years. And what that orange payment, the line of $32 million that stretches across years 1 through 25 is made up of is both a payment in terms of principal and interest. And so you can see that at the beginning of the lifetime of the loan, that annual payment is mostly interest. So the blue line is higher than the red or the pink line. And so at some point around year 8 or 9 in the lifetime of the loan, that switches, and principal becomes the larger share of that annual payment, and the amount of interest that's paid every year starts to decline. So this is the same figure with one additional thing added, which is on the second axis, y-axis. Now we're tracking remaining debt or remaining principal on the loan. And what we can see, and that's shown here by this bright green line. And so that line starts out at the capital cost or sticker price of the power plant, the amount of money that was borrowed, so $500 million. And gradually, as the loan is paid off, it declines to zero. And so what happens in year 1 through 25 is that the amount of principal each year that's being paid by the utility is subtracted from the remaining debt. And so as the amount of principal, as the share of the total annual payment in orange, the share of that payment that is actual principal, or red, increases, you start to see that green line decline even faster. And this especially takes place after the point at which principal becomes a larger share of the annual payment than interest. So another really, really important point to drive home here is that even though the power plant has a capital cost of $500 million, if you factor in the interest payments that it makes over the lifetime of the power plant and the loan, so 25 years, it will end up costing a lot more than that $500 million for the utility. Remember, the annual payment it makes, which is both debt and interest, is on the order of $32 million per year, or to be precise, $31.67 million per year. So if they pay that every year for 25 years, that does not add up to $500 million. It in fact adds up to $790. It adds up, in fact, to $792 million. So $500 million of that is the actual money they borrowed. $292 million of the actual cost of the power plant are the interest payments that the utility pays on the money it borrowed to build the plant in the first place. So now let's look at how the interest rate that the utility is experiencing, that it pays on the bonds that it issues, impacts its annual payment and the total cost of this power plant. So a higher interest rate means that they have a higher annual payment, and a lower interest rate means that they have a lower annual payment. And what we see at the bottom is a comparison between the actual amount of debt that they are acquiring to build this power plant, which is, let's say, the capital cost of the power plant, $500 million, and then the true cost of that power plant with a 4% interest rate and a 5% interest rate. And so you can see that the 5% interest rate increases the total cost of the power plant over the lifetime of the loan. Now, the next question is, what determines a company's interest rate? We now know that it's important, that the higher the interest rate that a utility experiences, ultimately, the more expensive its infrastructure is. So what determines a company's interest rate on debt? So a couple different things. Interest rates vary tremendously for a variety of reasons. And this gives you a sense for how interest rates have varied basically over the history of the United States, all the way back from the 1700s, the late 1700s, all the way through the most recent financial crisis in 2008 and onward. So market rates are important for determining a company's interest rate on debt. Another really important piece of what they pay has to do with their credit rating. And so this is similar to your personal credit score. A credit rating reflects the probability that you will not pay that money back that you borrowed or that you will default on your debt. So who determines credit ratings? Well, there are three main institutions that do that. They're Moody's, Standard & Poor's, and Fitch. One of the things that credit rating agencies might look at is a company's balance sheet to get a snapshot of their financial health, in addition to a lot of other financial information. So they might look at what assets the company has, for example, cash, and what infrastructure they have, as well as what liabilities they have. So what other debts are they going to be responsible for paying in the future? Other information that might be useful are larger market trends. If the company is in an industry or a market that isn't doing so well, then that might factor into a credit rating, as well as recent financial performance, and also an understanding of what types of events might disrupt a utility or a company's ability to pay their debts back on time. So the key takeaway here is that a credit rating reflects the probability of a company's default on their debt. And bad financial health indicates a higher probability that they will not be able to pay their debt back on time. And so bad financial health means a lower credit rating. And a lower credit rating means a higher interest rate on the debt that they borrow. So how would we explain this in layman's terms, the relationship between financial health, credit rating, and interest rates? Essentially, what it means is that if my financial health is poor, it's more likely that I'm going to default on my debt. So when I borrow money, an investor is going to require a bigger reward to offset that risk. In other words, they're going to want a higher interest rate and charge me a higher interest rate when I borrow money. So that's the connection between financial health, which if it's poor, I will be labeled with a lower credit rating. And a lower credit rating means I'll get a higher interest rate on the money that I borrow.